Good morning, I'm Rain Musngi and welcome to Follow the Money. Join us as we explore the tools and insights you need to jumpstart your financial journey. Stocks, bonds, funds, Forex. On this episode, we take a closer look at these investment instruments. What are the key differences and which ones are the best buys right now? We're joined by Antonio Moncupa Jr., former president of the Bankers Association of the Philippines. This financial market veteran also served as CEO of EastWest Bank for 16 years. Tony, good morning.
Good morning.
Thank you for
viewers.
Grateful you could join us. So for viewers who are not so well versed, let's share with them the main differences among the asset classes, how stocks, bonds, currencies, and other funds differ from one another. How have these funds performed in recent years, and maybe which platforms, sites, or maybe use of agents can we tap to be able to get on the market?
Okay. Well, when we classified into bonds, fixed income instrument, that means that these are liability of the issuing entity, whether they are government or private corporation or even individual. So what it does is that it's a promise to pay the investor a fixed amount of interest rate. Stocks, on the other hand, are part ownership of a corporation. So typically, the stocks are listed in an exchange, like the Philippine Stock Exchange, and there's a process of filtering or doing due diligence before they are listed. What it does is that the investor gets two things. They get dividends, if the company declares dividends, and that they get the price appreciation if the company does well, and price appreciation, that's their benefit. The main difference, though, is that the return on stocks are not guaranteed. Unlike the return on bonds, they're guaranteed. It's a fixed amount. And because of that difference, typically in theory and in most jurisdictions, because there is no guaranteed risk and nothing could happen, the stocks are considered to be more risky. So being the riskier asset, the natural consequence is that they are expected to pay higher returns in that sense.
So these are all useful information, but we kind of need to fix our audio at the moment. We'll get back to Mr. Moncupa in a moment. Stay with us. Welcome back. We apologize for the technical difficulties. We're still joined by financial market veteran Antonio Moncupa Jr. Thank you so much for staying with us, sir. Let's pick up where we left off. We were talking about capital markets as well as equities and the money markets. What about the likes of ETFs or even crypto or non-fungible tokens? Would you say that these are other investment instruments that are worthy for our retail investors?
Sorry, Ring. Sorry, I didn't quite get it.
Other investment tools such as NFTs, non-fungible tokens, or options as well as ETFs. Are these investment instruments that you would also recommend?
Those instruments are rather complex. When you talk about options, you're talking about derivatives, and ETFs. That's okay. It's like practically a stock. Crypto is another very volatile asset. To the uninitiated and those who are not very familiar, I would recommend a lot of caution because these are very risky instruments, especially the derivative and even crypto. It's not for the faint-hearted. Well, ETFs, if you approach it like a stock, you invest on something which you understand. And it's not like there are shortcuts to these things. the best shortcut you could do is to get into mutual funds or UITFs. They're practically the same, which are, pooled investments, But crypto, I belong to the camp who doesn't believe much in crypto.
And that's completely understandable. Of course, for retail investors, especially beginners, we really want them to be a little more conservative and more picky with their investment instruments. Now, moving forward, of course, we still have a lot of ground to cover, but we'll try to be as brief as we can. Interest rates, we have seen the BSP cut interest rates by 25 basis points last week. Of course, they affect whether investors put in or pull out their investments in all these tools. How have the recent Federal Reserve and BSP monetary policy decisions, do you feel, affected liquidity in the Philippine financial markets?
The direction that seems to be the consensus is that the BSP is on its path towards loosening monetary policy. So that should be good because when monetary policy is loosened, that means it encourages a lot more economic activities. So that should be good for companies, and that should result in better earnings because first, the economy become more robust, there's more economic activity, there's more demand for products, and also because lower interest costs would boost earnings. But the thing is, the direction of interest rates, to what extent it will go down, nobody could really be certain on that. For now, like for instance, the United States being the biggest economy in the world, has a lot of impact on how the other countries, including the Philippines, would react on the monetary policy. Because if we lower interest rates and the U.S. does not lower interest rate, it puts pressure on the dollar-peso exchange rate. And if the peso depreciates, it has its own economic repercussions, which are sometimes problematic, in terms of it makes the cost of imports higher, and eventually the cost of consumer items higher because we import a lot of items from the world. So, but generally the idea is the lowering of interest rate should be good for corporations. But on the other hand, this is a big consideration. In theory, when you lower interest rates, it's because the economy needs a boost. And when the economy needs a boost, that means that there's some problem with demand and growth. And you don't want that to proceed. That's why in the US, inflation, of course, is the number one problem. But, hello?
Yes, continue. Sir Tony.
Rain?
Yeah. All right, we seem to have lost Mr. Tony Moncupa again, veteran financial markets, veteran of the financial markets, but we will try to get him back on the line for you. Meanwhile, we can take another break. Welcome back. Thank you so much for staying with us, Mr. Moncupa. Hi, Tony. Just one last question, perhaps to wrap things up, just to be able to ground things. On a personal finance level, looking at all these asset classes and all the factors that affect the markets, is there an asset class that you would recommend to our retail investors at the moment?
The typical investment that would be more balanced, I guess, would be a mix of stocks and fixed income. And it's good. It somehow inoculates your portfolio if you have the two, because when bonds go up, typically, that means when interest rate goes down, that means that investors there will have capital gains, but that's good also for fixed income. But I would not be how much bonds and how much equities one would invest into will essentially depend on several key factors. One is that investors should ask what is their risk tolerance. Because again, the basic rule that higher returns also means higher risk, it's still very much true. There is no such thing as higher return and low risk. So one has to establish what level of risk are you comfortable with. The second one is some technical expertise, because we need to understand what we're getting into. After all, it's our money and we need to protect our money. So we need to study, or if not, there are many investment advisors. Banks offer that. There are mutual fund companies offer that, and there are many more professionals who spend their time studying the financial markets. That's another option for our investors. But for the ultra conservative, they could stick to fixed income. Otherwise, the volatility of the prices could be, nerve-wracking if you're not used to it. Just take a look at the foreign exchange. A couple of months ago, it was trading at around close to 59. Now I see it's 56, 70. That's a kind of volatility, or even crypto at 70 at some point, and then it goes down to 60 in a matter of days. And even fixed income, last week there was a sell-off in equities and fixed income instrument. The 10-year U.S. Treasuries went down to as low as 3.6. Then before now, it's back to about 3.9. There's a lot of volatility now in the market, and these are, to those who are not used to it, it could really be troublesome. And also one need to consider your time horizon. I would not advise investing the money that you will need in a couple of months in this instrument. These are very risky. So maybe you should stick to the money market or short-term investor. Anyway, now because rates worldwide are expected to go down, the short-term rates are very high. So it's a lot of consideration that one has to think about when trying to invest your money. And I would suggest it too.
Well, certainly lots of reasons to consult an investment strategist, an investment expert, and lots of reasons to have former Bankers Association of the Philippines President Tony Moncupa back on the show at a later date, perhaps with better technicals. A pleasure to have you today, and thank you for sharing your thoughts with us.
Thank you very much for the opportunity, Rain.
We appreciate you. And before we go, we leave you with a quote from one of the most successful investors of all time, Berkshire Hathaway CEO Warren Buffett. An investor should act as though he had a lifetime decision card with just 20 punches on it. And that's it for today's edition of Follow the Money. I'm Rain Musngi. Thank you so much for watching. Keep it here on BNC, the Bilyonaryo News Channel, always on top.